Selling an investment at the right time isn't just about getting the best price. It can also make a huge difference to your tax bill. In Australia, timing your investment sales around the end of financial year using capital loss harvesting and thinking about your income levels can legally reduce how much capital gains tax you pay. In this video, I'll walk you through when and how to sell an investment to minimize CGT with simple strategies anyone can use. Let's get into it. End of financial year strategy, selling before or after 30th of June. 30th of June is the Australian tax year cutoff. Selling just before or after this date affects which financial year the gain is counted in. Here's how to think about it. If your income is high this year and you expect it to be lower next year, wait until after July 1st to sell. Your CGT will be lower. If you have capital losses this year that you want to use, consider selling before the 30th of June to offset the gain. Of course, don't forget each year's tax rate could be different for individuals. The new 2026 financial year tax rate has significantly reduced from 2025, and the income threshold changes too. Example, you're made redundant in May and won't have much income next financial year. Selling your investment after July 1st means that gain is taxed when your income is low. On the flip side, if you've made poor performing investments this year and want to realize the loss to offset a gain, you might want to sell both before the 30th of June. Loss harvesting, using capital losses to offset gains. Capital losses can be used to offset capital gains, either in the same year or carried forward to future years. So if you sold shares at a $10,000 loss earlier this year, and now you're selling another parcel for a $15,000 gain, you'll only pay CGT on the $5,000 net gain. Loss harvesting is legal, widely used, and very effective when done before the 30th of June. But remember, you can't offset capital losses against regular income, only against other capital gains. You also can't sell an asset, typically like shares or crypto, just before the end of the financial year, and buy it back immediately. That's called a wash sale, and the ATO watches out for it. Income averaging and low income years. This is where strategy really comes in. If you're planning a year off work, parental leave, a sabbatical, or early retirement, that year of low income could be the perfect time to sell, because CGT is added on top of your income. The lower your income, the lower your tax rate. For example, selling a long-term investment during a year where you only earn $30,000 could mean your capital gain is mostly taxed at 16% or 30% instead of 37 or 45. Planning ahead makes a huge difference. Final tips for timing your sale. Here are some smart habits to follow. Always check your current income and tax bracket before selling. Look at any capital losses you can use. Consider future income changes, especially in June. Talk to your accountant before making big sales near end of financial year. If possible, spread sales across 2 financial years to avoid spiking your income. And remember, tax shouldn't be the only reason to sell. But when the timing's right and you have a good gain, it's worth planning around. So, when is the best time to sell an investment? It depends on your income, your losses, and the financial year. Use the tax rules to your advantage, and you could save thousands in capital gains tax. If you found this helpful, give it a thumbs up, subscribe for more smart tax and investing tips, and feel free to leave me a comment below. Thanks for watching.